What if buying a home doesn't only increase your wealth through house appreciation, but it also kept you from paying more money to Uncle Sam and lowered your tax bill? Whether you're buying your first home or wanting to invest in property, I'm going to walk you through the most powerful tax benefits of buying residential real estate. And stick around to the end because I'm going to share a nugget that's helped many thousands of investors save money with Uncle Sam to avoid paying taxes that they didn't even know existed. Okay, y'all, the government wants us to buy real estate. They want homeowners to be better people in the community. You're better employees when you own real estate. You're invested in the community that you live in. You're just a better contributor to society when you own a home. There's statistics around all of these attributes. Home ownership and investment in property are so crucial to our economy that the government actually gives you tax benefits to help the decision be just that much easier. But most people are leaving money on the table because they simply just don't understand what they're entitled to. Let's talk first to homeowners. That means you're buying something to live in as your primary residence. There's 3 main perks that you need to know about. Number 1 is a mortgage interest tax deduction. So every year, your lender is going to send you a form with the amount of mortgage interest that you paid if you have a loan. Currently, at the time I'm making this video in 2025, you can deduct up to interest on up to $750,000 of mortgage principal on your tax return if you're filing jointly. So let's say that your loan is $400,000 and your interest rate is like 6%. Your mortgage interest yearly is around $24,000. That means you're going to get a form in the mail every spring that says that you have paid $24,000 in mortgage interest. You can deduct that line by line. There's a space in the tax return where you can say, I paid this much interest on mortgage, and that's going to reduce your taxable income. So let's say that your gross income before taxes are taken out is $80,000. If you subtract that $24,000 from that, that means that you're paying tax essentially on only $56,000. But there's more. There's also something called a property tax deduction. So if you own a home, you definitely pay property tax. That goes to your state, local, school. Homeowners pay property tax. Currently, you can deduct up to $10,000 max. It used to be more. Cry, but now it's $10,000. And that's in addition to the mortgage interest that you're paying. You're able to also deduct up to, well, what you pay. If you pay $6,000, you're only deducting $6,000. But if you pay $10,000 or more, the cap is $10,000. So you can also deduct that from your taxable income. So in that case that I gave before of the $400,000 loan and the $24,000 in mortgage interest, if that person's property tax was, let's say, $11,000 a year, they could take $10,000 of that, add it to the $24,000, and essentially reduce their taxable income by $34,000. Okay. That's a mouthful. I hope that you're still with me because there's more. There's also a capital gains exclusion. This means that when you sell your house for more than you bought it for, what's your profit is called a capital gain. Now, normally people pay taxes on capital gains, but if you've lived in the home at least 2 years as your primary residence, you can exclude up to $250,000 if you're filing by yourself, if you're not married, or $500,000 if you're married and filing jointly. Now, I do want to say I'm not a tax professional. I got this right off the internet. It's easy to look up, but I definitely want you to talk to your tax professional about how this applies to you. Now, I'm about to sell my house. We're going to make a certain amount of money. we're also going to deduct any big time improvements. We've remodeled our house. We've, put money into the house over the 10 years that we've owned it. So we're going to get to deduct that from our all over profit before we calculate, are we, how much tax would we or would we not have to pay? So again, it's a mouthful, but just know that that's there. You can check all this on the IRS website, or you can just call a CPA or accountant and they can tell you too. That is one of the best kept secrets in real estate. That's why I believe, and I will always believe, that real estate is one of the best wealth building activities for people. So to recap, people buying real estate, residential real estate as their primary residence, can deduct from their income tax, property tax you pay up to a certain amount, mortgage interest that you pay, and also you can escape tax from capital gains up to those certain amounts that we talked about. That's super cool. But what about real estate investors? That's where things get really, really interesting. Let's talk about investor tax benefits. When you're buying real estate as an investment, you're not only building long-term wealth, you're also tapping into one of the best tax-advantaged asset classes in the U.S. Let's talk about the three strategies that investors can save on taxes. Depreciation is the MVP of all tax benefits. The IRS lets you depreciate your property over 27.5 years if it's a residential rental. That means that if your property value is going up, you get to pretend that it's going down. That's cool. For example, if your property is worth $275,000, you can deduct about $10,000 a year in depreciation, even if you're cash flowing on the property. Now, again, I'm going to repeat, I am not a tax professional. I was able to find all of these things online, and I also am in the business for a very long time, so I know all this, but you want to check with your tax professional to see how this could apply to you. The second thing is expense deductions. You can line item expense deductions of things that you pay for the property. Repairs, management company fees, utilities, property insurance, mortgage interest, property tax, basically everything you pay to maintain the property. And all of this reduces your net taxable income. The third thing is passive loss rules. This is a great strategy for high income households. If your properties are generating losses, usually from depreciation, you can use that to offset other passive income or even regular income in some cases. Again, you want to check with your tax professional to see how this is going to apply to you. Here's the strategy that I teased about earlier. A 1031 exchange lets you sell a property for a profit, and you can roll those profits into the next property. It doesn't even have to be a property of the same type. You can sell a ranch and use it to buy a commercial building without paying capital gains on it right now. Okay, I have a video about this that I made. It was very fun to research this. It's down in the description about 1031 exchanges. So after you watch this, check it out. But basically, you're deferring your tax bill. You're rolling over the profit because you're investing. It's to encourage investment in other property. It's amazing. And this is how savvy investors keep their tax bill low and grow their wealth rapidly. If you do sell a rental and have a gain and don't do a 1031, you will be subject likely to capital gains. As of right now, that's anywhere from 0 to 20%, depending on your income. Check with that tax professional, again, to see how that applies to you. Don't worry, I won't leave you without a few cautionary flags. Make sure that you separate personal and rental expenses. Don't commingle the two. Keep really tight records. Work with a CPA that knows real estate. And don't forget about recapturing depreciation if you sell. You don't want to accidentally owe taxes later thinking that you could have deducted them. So again, good CPA. And don't assume that your primary home works the same as a rental, because it doesn't. The rules are totally different. The bottom line is that owning real estate, whether it's your primary residence or investment, puts you in a different tax category. It's one of the few investments where you can grow wealth, collect income, and pay Uncle Sam less money. If you're a homeowner or an investor, it doesn't matter. You're already super ahead of the game by learning this stuff. So thank you for watching the video. If this was helpful, hit the like button, throw me a comment, and please join me again. I release videos every week. I'm Jen Hernandez. I'll see you on the next video.